Hey traders, welcome to Charts and Coffee. Hope everyone is doing great. Happy New Year. Looking forward to trading with you all 2024. Very excited for where we are in terms of the macroeconomic cycle. When I hop into the Sector Secrets Mastery room this morning and the futures room this morning, we're going to talk about the 5 things to look out for the first week of 2024. We'll definitely have an update on that over at countdowntrader.com as well. But let me give you a little taste of what we're going to be talking about. And then that way, when you catch those updates, you got to get a taste of what it is you got to watch for as we go into just this first week, right? Because look, the implications for what's going to happen in March and earnings season and all those are a separate conversation. Right now, we're talking about the immediacy. And the first place I'll recommend looking at is our normalized performance. What are the sectors that led the way these last 12 months? Even the last 3 months is fine, right? You can juxtapose those two views, the last 1 year, the last 3 months, because that's where the A, relative performance is going to be obviously ranked, and B, if there is rotation versus something that is seldom talked about, which is participation. What if we don't have to see semiconductors and tech see profit taking for energy, healthcare to move higher? What if we don't need to see sector rotation? What if money comes off the sidelines? That's participation, broader participation. That's what I definitely keep a really, really close eye on as we go into this first week. And then the other thing that I'm going to mention is really briefly, that will also pinpoint a little bit more accuracy around window undressing. We've talked about window dressing for so much of the last month. I mean, that's been a steady conversation. Don't be a bear in December, especially in those corners of the broader equity markets that have been strong. Strength gets stronger and weakness gets weaker. And weakness getting weaker, a lot of folks ask me, what about tax loss harvesting? Not on a last quarter before a year where we are already undergoing, messaging wise, a dovish pivot. We don't really want to look for weakness all that much. There's more chance of the high tide of the Federal Reserve preparing the markets, preparing us for whether that be treasuries, currencies, indices, energies, metals, for lower rates to come. That is a coming. I don't care what anybody says, gang. It's being factored in unless Jerome, and he's done this once, he ain't going to do it again. Unless he wants to defy the expectations of the Fed fund futures, of those target rate probabilities. He did it once in Q4 of 2018. A lot of you will remember that was one of the sharpest sell-offs that we had ever seen in modern markets, the first quarter of 2019, when he did not pause. Believe me, he's not looking to defy these target rate probabilities again. He did it, and it was whoopsie. Yeah, he's not going to do it again. All right, gang. So just a taste of what'll be coming over at the countdowntrader.com later on, I think today or tomorrow. All right, let's get to it. As always, if there are any questions at all, feel free to type them on in. Absolutely, yes. Happy New Year. Good morning. Good morning. All right. So first question, some tech. All right, Sadiq asks, I have a 2-part question. All right, what date should we anchor the VWAP max? Don't change anything yet. Second, don't change anything yet. There's not enough data to do it, my friend. So leave it on the other anchor. And yes, the Trish boss is letting me know that update will be posted at countdowntrader.com later today. All right. So the second part of the question. So should you move the VWAP? Not yet, Sadiq. I'll probably do that the 2nd to 4th week of this month. Second is the 30-minute time frame V profile. Is the 30-minute time frame V profile good enough to measure against the previous day's value area? Well, Sadiq, remember, anytime we're looking at volume and we're looking at an anchored volume study, it's not a matter of it's good enough. The question is it measuring the requisite amount of data to be helpful? Is there enough information on a 30-minute VWAP anchored to when, right? When is that V profile being anchored? It's being anchored likely at 9:30 this morning, maybe 7 if you're using some of my alternative anchors, right? So I would say it's not a matter of measuring against. It's not even a comparison. Use them both. Know where the previous day's point of control, value area high, value area low was. And then if you want to look at today's levels via the 30-minute or a 5-minute, it actually makes no difference, right? We're looking at the volume since 9:30, juxtapose them. I wouldn't say one is good, one is bad. I wouldn't say one replaces the other either. They're two different things, right? So thank you for the question. And yes, volume is definitely something we want to think about. Volume is definitely something that for those of you that have been following anything we've been doing here in Charts and Coffee or in the Sector Secrets Mastery, the two factors that have continued to give us an edge, right, is not more price-driven indicators. I don't need another combination of open, high, low, close to know what price is doing. We have plenty of amazing indicators that do that. There are 4 factors in the market, right? Price and time are probably the 2 that most traders are aware of. When certain data releases are coming out, when earnings are coming out, pit bull lows, end of quarter, non-farm, those are all time category events. Of course, price, open, high, low, close. But what about volatility and volume? And a lot of times, if there's a hole in a trader's game, if they're missing things, they're missing the beginning of a trend, if they're missing the waning moments of a trend, if they're missing the importance of a pullback, knowing the difference between that potentially breaking a trend and it only being a mean reversion or a retracement, those are usually shortcomings in the volume and volatility indicator side of things, right? So we're forcing certain indicators to tell us things they couldn't possibly tell us. So volume is a great way to kick off the new year. Absolutely. All right, next up, Megawatt asks, PLD on the daily for a long swing trade, what would be a good entry? You have 2 ways to go about this. So first of all, I agree, Megawatt. It would definitely be a swing. It's in an uptrend. We want a retracement or a mean reversion. That's going to put us anywhere on this gap close around 120.20 down to 126.5. The Darvis would be a gap close, and I would just consider that a more aggressive support level for a swing, entry long calls. Or if you want a more meaningful mean reversion, it's not that wide a chasm anyways. You can consider them 2 triggers, maybe one aggro and one moderate, and budget your dollars accordingly to buy calls at each one of those price triggers. Again, about 129.20 and then 126.50. Those would be the 2 levels that I'd be watching. All right, next up is, so great reminder, gang. We have the New Year's sale continuing on until Friday, right? This Friday? Until Friday. So take advantage of it. If there are tools, indicators, services that you've been wanting to try out, do it while it's on sale, gang. Take advantage of it. All right. Next up, Larry asks, don't markets traditionally sell off with rate cuts, at least initially? Larry, I wouldn't say that's necessarily the case. I think it depends on the context of when the cuts came. But as a general rule, again, I don't know what you mean by initially, the first day, the first week. No, that's not been my experience, though, Larry. Generally speaking, equity markets love cheap money, lower lending rates. They love when the Fed is being more accommodative. So no, I don't believe that to be necessarily true. I mean, if you look at 2019 Q1, after the Federal Reserve decided not to pause and instead hiked, massive sell-off. They paused and then they started to cut. 2019 was a rallying kind of year. 2020, we know what happened in 2020. And it wasn't until the Federal Reserve started to become extremely accommodative that the equity markets rallied. The equity markets can rally with higher rates. We've seen that too through 2023. Now, I'm not going to say that, gang, as soon as they cut, it's up and away. But remember, generally speaking, lower rates mean a lower 30-year yield, a lower 10-year yield. It means weaker dollar. And what's going to happen is it's going to basically siphon money to seek out alpha, to seek out return. And when rates start to drop, it's usually equities are where that, more risk appetite oriented equities. Take a look at what rallied at the end of last year. That's probably a pretty good harbinger for the kind of movement to come. But Larry, to your point, we always want to be ready for the possibility that that tendency, that knee-jerk reaction, if you will, the patellar tendon reaction doesn't occur, right? We want to be ready for that, but I would not go into it expecting a lot of bearishness. Now, there is a buy the rumor, sell the news response to anything that we're expecting to come, getting it, and then just taking profit on the reality that we thought was going to happen. So we rally the markets up in anticipation of a cut. We get the cut, we take profit. However, that's why I was saying the way they cut, the messaging around the cut is going to be so important, because if they cut and they sound a little bit, not one and done, but more wait and see, at that point, traders might think, wait a minute, we've discounted a cut in March and May. If the March cut comes and the May cut's really not in any way sort of mentioned, or the statement doesn't make it sound like it's likely, that would be a scenario where a rate cut could present a pullback, right? Not because we didn't get the cut, but because when you look at Fed fund futures as they stand right now, there is an expectation for March and May, and by the way, June, to be 3 meetings with the Federal Reserve cuts a quarter point. If they don't start to allude to that, if they don't keep that possibility open, if not probable, that's where, to your point, that could happen. All right, next up, and thank you for the question, Larry. Another great topic to consider as we start off the year. All right, Munair asks, can I talk a little bit more on open interest on strikes for stocks under $20 being an indicator for me? No, my friend, volume, not open interest. Although open interest would be fine too. So size. So let's talk about size, Munair. So the thing is, if a stock is under 20 bucks, and I really can't even think of one off the top of my head, usually other than Rig. And I don't like sub $20 stocks as a general rule. And by the way, there aren't that many of these types of stocks, sub 20, weighted within the broader averages. So it's usually not a stock that's going to end up on my radar because of the kind of scanning that I do. All right, but let's say we take Rig. And it's not open interest, although that's fine. That's one way of looking at size via volume participation, right? But what I'm talking about is something that I would pull up, and I don't have it running at the moment. I was going to start it up here in just a moment, but why not do it now? I'll start up my Trading View. So the Trading View platform, let's go on over there. Boom, there we go. So the Trading View platform allows me to look at volume in another way that I love to look at it. And that's via price-based volume, otherwise known as volume profile. So if I look at Rig and I start to look at visible range volume profile, all right, when I'm looking at visible range volume profile, give me one sec, and I'm looking at how much size happened at a certain point. All right, bot seems to think everybody now is going to think that I'm not using open interest. Bot, you can't be serious. There's no way. All right. So what do we want to remember? The question is, do I look at open interest on stocks under 20 bucks? No, we look at price-based volume, right? We look at price-based volume. We'll look at volume profile. We'll look at how many shares were traded at a certain price. Now, if we want to know additionally and separately how many contracts are being traded in Rig at a certain strike, how many options are active in terms of contracts at a certain strike, let's say I look at the Jan 5 Rig open interest. So one, volume profile, is a conversation about shares. Number two is a conversation about the activity around the option. So this way, bot, all right, open interest and volume, two different things, both worth watching. The open interest, and this might be worth noting, Munair, the Jan 5 open interest that is the greatest amount of contracts being traded is at the 7 call, the 7 strike call. So there is a little bit of gravitational pull. There is a little bit of an attraction to that level that may not be seen at the share level. So remember, again, when we're talking about size, volume is one way to do it. Open interest is another. Volume will tell me when I'm looking at volume profile on TradingView, I'm looking at how many shares were traded at that price. When I'm looking at my option chain, pull up Tasty, pull up Thinkorswim, and I want to know the number of contracts that are open at a specific strike, how much attention, that's open interest. All right. So that's what I want to look at there in terms of separating out the two. Now, you mentioned IONQ. Look at pull this up on TradingView. Look at the open interest on that contract. Look at the visible range volume profile. Visible range volume profile shows that there's a point of control. The most volume that's occurred in the last 12 months happened at about $13.50, right? $13.62. That's where most of the, and this doesn't matter that we're looking at relatively illiquid stocks, gang. We could do this with Apple too. We could do this with Tesla too, right? So I'm looking at IONQ, which I'll be frank, I have no idea what it is. Don't need to, right? And if I look at where the 2023 point of control is, 1362 is where the point of control is. That's the most number of shares traded in this stock. Now, if I go over to January 5, all right, and this looks like one of those stocks where, yeah, it's trying to get going. It's above the 200. I'd be more bullish than bearish. Okay. Now what I can do is pull it up on my platform here, and I'm looking at it on Thinkorswim. January 5, very illiquid. So there's not a lot that I'm going to glean from the Jan 5. Jan 12 is very, very illiquid. Jan 19, a little bit more. The most open interest in this stock for the Jan 19 expiration is the 15 call, followed by the way, the 12 call. What does that tell you? Not a lot. However, I'd be a little bit more optimistic about 15, more open interest. We're above the 200. We're above the anchored VWAPs. More reason to be bullish than bearish. Okay, so that's how you break it down. So again, don't get thrown if I'm looking at inexpensive names like Raghee or whatever this IONQ is. It doesn't matter. But if you are looking at sub $20 stocks, size matters. What do we know size is now? Open interest and volume, price-based volume, visible range volume profile, right? How many shares occurred at a certain price? And then if you want to do it on, the Apples and the Teslas and gosh, the whatever, the SPYs of the world, you can absolutely do that as well. It tells you a lot because what is size? Size is attention. Size lets us know where money has already been committed. We're not predicting anything, right? We're saying, where has the elephant already stomped across that damp sand and left those footprints, right? I don't need to trade like the big money, right? I think there's an obsession about what are algos doing? What's the big money doing? What's the institutions? You don't think they spend an inordinate amount of time trying to be very tricky, secretive, downright deceptive about what they're doing? Of course, that's their job. I don't blame them. It's also my job to find the cues of those little breadcrumbs, right, that they leave behind. One of the best is size, right? It still is very much that. So think about that when you're trading. That's something that we talk about a lot in the mastery, which is where's the size? Where's the attention? And then remember, the truth of it is, great trades, we're never in them alone, gang. We can't be, right? We could be there first. We could be there in the middle. Heck, we could be there last. But as long as we're there with the group, it's like catching a wave going into the shore, right? I can't make the wave on my own. But if I'm good at what I'm doing, if I'm good at surfing, I can find that wave and ride it in. That's our job. Not to make the waves. Let the big money do that. That's their job. I don't want their job. I like my job. I'd rather be surfing. So think about that this year, gang. We'd rather be surfing in 2024, and we will have some nice bullish waves if the macro continues to pan out. As always, gang, Happy New Year. Great to have you here for Charts and Coffee. We're embarking into year number 1, 2, 3, 4. I think we're going into year 4, 3, whatever it is. It's been a lot of years. Thank you for watching. Caffeinate and dominate, my friends. I'll see you in the next update. And heads up, again, make sure you check out countdowntrader.com later on today for the 5 things that I'm looking at this first week of 2024.